The single greatest secret in trading is not a secret at all. It is a law as universal and unforgiving as gravity. It has been etched into the careers of every market legend, from the speculators in the gaslit offices of the 19th century to the quantitative hedge fund managers of the 21st. It is the one principle that separates the consistent professional from the hopeful amateur, the survivor from the market's victim. This law is not about finding the perfect entry, predicting the next big move, or possessing some mystical insight into the market's intentions. It is far more fundamental, far more critical. It is the unwavering, non-negotiable, absolute commandment of capital preservation. The legends of the market did not become great by being right all the time. They became great by ensuring that when they were wrong, the damage was minimal, controlled, and survivable. Their genius was not in their foresight, but in their discipline. They understood that large profits are the children of small, manageable risks. True opportunity is not born from reckless courage, but from the patient accumulation of capital preserved through countless disciplined decisions. Today we will dissect this universal rule, not through theory, but through the hard-won lessons of the masters themselves. We will explore how a relentless focus on risk is the only foundation upon which a lasting trading career can be built. Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. The philosophy can be distilled into its purest form by two masters from different eras and disciplines. First, Warren Buffett, the investor who built an empire on value and compounding, laid down his two primary rules in his letters to Berkshire Hathaway shareholders throughout the latter half of the 20th century. Rule number 1. Never lose money. Rule number 2. Never forget rule number 1. This is not a clever quip. It is the bedrock of his entire methodology. It signifies that the avoidance of a permanent loss of capital is mathematically superior to the pursuit of spectacular gains. A 50% loss requires a 100% gain just to break even. The math of loss is a brutal tyrant, and Buffett's first priority is to never fall under its rule. From the other end of the spectrum comes Ed Seykota, a pioneer of trend following and systems trading who began his legendary run in the 1970s. His world of futures was fast, leveraged, and unforgiving. His conclusion, forged in the crucible of moment-to-moment market volatility, was identical in principle, though phrased with the urgency of a pit trader. When asked about the elements of good trading, he famously replied, "The elements of good trading are 1. Cutting losses, 2. Cutting losses, and 3. Cutting losses. If you can follow these 3 rules, you may have a chance." Buffett, the patient investor, and Seykota, the systematic trend follower, arrived at the same immutable truth. Your first job is not to make money. Your first job is to protect what you have. Profit is the byproduct of excellent defense. Every strategy, every analysis, every decision must first pass through the cold, hard filter of risk management. Without it, you are not trading, you are gambling. And the house, which is the unforgiving mathematics of probability, will always win in the end. This is the universal rule, and its application is what we will spend the rest of our time examining. Perhaps no single figure in market history embodies the brutal education of risk management better than Jesse Livermore, the great bear of Wall Street. His story is a violent oscillation between immense fortune and catastrophic ruin, and at every turning point, the lesson was the same. Control your losses, or they will annihilate you. Livermore's early education took place in the bucket shops of the late 1890s, establishments that were essentially betting parlors against the stock market. They were not legitimate brokerages. Customers bet on price fluctuations without any underlying shares being traded. The bucket shops had a fixed edge. They could manipulate quotes or simply refuse to pay out. For a young Livermore, this environment taught him to be right and to be right now. There was no room for error. But his first true lesson in the public markets came in 1901. Having amassed a stake of over $50,000, a colossal sum at the time, he took a large, long position in Northern Pacific Railway. He was correct in his analysis. The stock was in a powerful uptrend. However, a titanic struggle for control of the company erupted between two financial giants, E. H. Harriman and the J.P. Morgan/James J. Hill alliance. Their aggressive buying caused the stock to rocket from under $150 to over $1,000 per share in a matter of days, creating a historic short squeeze. Livermore, being long, should have made a fortune. But his brokerage firm, unprepared for such volatility, raised margin requirements so drastically and repeatedly that he was forced to sell his position for a fraction of its potential worth. He was then wiped out on subsequent trades, losing his entire stake. The market had been right, his position was right, but his risk exposure was wrong. The volatility of the situation, a factor of risk he had not properly accounted for, destroyed him. He learned. He rebuilt his stake, and in the panic of 1907 he applied the lesson. He saw the speculative froth, the over-leveraged positions, and the tightening credit conditions. He began to build short positions, adding to them as the market confirmed his thesis. He was not fighting the trend. He was identifying its end and a new one beginning. When the crash came, he was positioned correctly. While Wall Street was in ruins, with banks failing and fortunes vanishing, Livermore walked away with his first $1 million. The press dubbed him the boy plunger, but his success was not from plunging. It was from calculated risk based on his developing rules. He had a stop-loss point in his mind for every trade. If a stock moved against him by a certain amount, he was out. No questions, no hope, no hesitation. His most legendary feat, of course, was the 1929 crash. Throughout the roaring 20s, as the public became intoxicated with a new era of permanent prosperity, Livermore remained skeptical. He saw the classic signs of a speculative top. Massive public participation, brokers' loans expanding to unsustainable levels, and price action that was detaching from all fundamental reality. He began probing the short side, taking small losses as the market continued its final frantic ascent. This is a critical point. He did not nail the top on his first try. He tested his hypothesis, took small, disciplined losses when proven wrong, and waited. He was preserving his capital, keeping it ready for what he called the pivotal point, the moment the trend would definitively turn. When that moment arrived in late October 1929, he was ready. He deployed his capital aggressively into short positions. As the market collapsed with unprecedented violence, his fortunes swelled. By the end of the crash, Jesse Livermore was worth an estimated $100 million, equivalent to well over $1.5 billion in today's currency. He had achieved the single greatest trade in history. But he always insisted that this victory was not born in October 1929. It was forged in the discipline he learned from his earlier failures. He famously stated, "The stock market is never obvious. It is designed to fool most of the people, most of the time. The only defense against being fooled was to never allow a single trade to cause you irreparable harm." He preached against averaging down, calling it a cardinal sin. To buy more of a losing stock was, in his words, to throw good money after bad, an act of pure ego and hope against the clear verdict of the market. His legacy is a testament to the idea that you must keep your capital intact so that when the once-in-a-decade opportunity appears, you are one of the few with the resources and the mental clarity to seize it. This entire journey, with all its psychological depth, is masterfully chronicled in Edwin Lefebvre's Reminiscences of a Stock Operator, which is presented as a fictionalized biography of Livermore. It is arguably the most important book ever written on trading, and its central theme is the brutal but necessary education in managing risk. For those who are committed to a deeper, more methodical study of these principles, we highly recommend the edition that features a unique, detailed chapter-by-chapter analysis by Max Davidson, an interpretation specifically designed to translate this century-old wisdom for the modern reader. A link to this essential edition has been provided for you in the description below. Decades later, another legend would echo Livermore's sentiment with even more brutal simplicity. Tudor Jones, one of the most successful macro traders in history, built his empire on a foundation of obsessive risk management. His philosophy is encapsulated in a phrase he famously taped to his office wall: "Losers average losers." This was not just a catchy slogan, it was the operational command for his entire firm. There was zero tolerance for adding to a losing position. If a trade went against you, your only job was to get out. You could re-enter later if the setup reappeared, but you would never compound an error. This philosophy was put to the ultimate test in October 1987. Jones and his young analyst Peter Borish had been meticulously studying historical market patterns. They discovered a chilling parallel between the chart of the roaring 1980s bull market and the market leading up to the 1929 crash. Jones became convinced that a crash was not just possible, but imminent. He didn't just have a theory, he had a plan built entirely around risk. He began to structure his portfolio for a violent decline, using futures to build a significant short position. He understood that being early could be costly, so he managed his entries and risk with surgical precision. On October 19, 1987, Black Monday, his thesis became a terrifying reality. The Dow Jones Industrial Average plummeted 508 points, a staggering 22.6% in a single day, a percentage drop far worse than any single day in 1929. It was financial Armageddon. The world's markets were in freefall, and fortunes built over a decade were vaporized in hours. But while the world panicked, Tudor Jones's firm was a sea of calm. His team executed their plan. They didn't just survive the crash, they profited immensely, reportedly making over $100 million in a single day. His Tudor BVI fund would end the year up around 200%. How was this possible? It was not due to a magical crystal ball. It was due to a risk-first mindset. Jones often spoke about his goal of finding trades with a 5-to-1 risk-reward ratio. This meant that for every dollar he risked, he aimed to make 5. If he saw a trade where he could risk a 1% loss for a potential 5% gain, he would take it. The power of this asymmetry is staggering. With this approach, you can be wrong 4 out of 5 times and still break even. If you are right just 30% or 40% of the time, you become incredibly profitable. His entire strategy was geared toward finding these asymmetric bets and then ruthlessly cutting the trades that didn't work immediately. The 1987 crash was the ultimate 5-to-1 trade. He saw the potential for a massive, historic decline, the reward, and structured his positions so that if he were wrong, his losses would be small and manageable, the risk. He did not average into his short positions as the market moved against him before the crash. He waited, took small paper cuts, and preserved his capital until the market finally validated his thesis. His success was not about being a prophet, it was about being a phenomenal risk manager. While macro traders like Jones managed risk based on broad theses and asymmetric bets, another school of thought was developing a more mechanical, rules-based approach to the same problem. William J. O'Neill, founder of Investors Business Daily and author of the CANSLIM methodology, approached the market from a different angle. Starting in the 1960s, he conducted one of the most exhaustive quantitative studies of the market's greatest winning stocks over the preceding century. He wasn't looking for opinions or forecasts. He was looking for common, measurable characteristics that these super performers displayed before their massive price runs. The result was the CANSLIM system, a 7-point checklist for identifying high-growth stocks with the potential for explosive gains. But O'Neill knew that identifying potential was only half the battle. Many of these high-growth, high-momentum stocks were also incredibly volatile. A stock that can rise 100% in a few months can also fall 50% just as quickly. He understood that without a rigid, non-negotiable defensive strategy, his system would be useless. His solution was as simple as it was brilliant: a mandatory 7% to 8% stop-loss rule on every single trade. This was not a guideline. It was not a suggestion. It was an absolute, unbreakable law. From the moment he purchased a stock, the maximum loss he was willing to accept was 8%. If a stock dropped to that level from his purchase price, it was sold. Period. There was no debate, no second-guessing, no waiting to see if it would come back. The logic behind this rule is profound. First, it completely removes emotion and ego from the decision to sell a loser. The decision is made for you before you even enter the trade. You are no longer hoping or praying. You are executing a predefined plan. Second, it protects your capital with mathematical certainty. The damage is contained. A series of small 8% losses is easily recoverable. A single 50% loss can be a career-ending event. Third, and perhaps most importantly, it acts as a performance filter. O'Neill's research showed that the greatest winning stocks rarely, if ever, declined 8% below their proper breakout points. If a stock did drop that much, it was, by definition, not acting like a market leader. The 8% rule was therefore not just a defensive measure, it was a diagnostic tool. It told him his initial thesis was wrong, and it did so quickly and cheaply. This mechanical approach also protected his psychological capital. By keeping losses small and manageable, he avoided the mental anguish and decision paralysis that comes with holding a large losing position. This allowed him to remain objective, clear-headed, and ready to redeploy his capital into the next opportunity that met his stringent CANSLIM criteria. William O'Neill demonstrated that a successful trading system is a two-sided coin. One side is the methodology for identifying opportunity, and the other, equally important side, is the non-negotiable mechanism for managing risk. Without the 7 to 8% rule, CAN-SLIM would just be a list of interesting stocks. With it, it became a complete blueprint for compounding wealth. The idea of systematizing risk was taken to its logical extreme in one of the most famous experiments in trading history, the turtle experiment, conceived by legendary futures trader Richard Dennis in the early 1980s. Dennis had a long-running debate with his partner, William Eckhart. Dennis believed that great traders could be made, that trading was a skill that could be taught and learned like any other. Eckhart argued that great traders were born, possessing an innate talent or intuition. To settle the argument, Dennis decided to recruit a group of ordinary people from all walks of life: a security guard, a Dungeons and Dragons master, an actor, and teach them his exact trend-following trading system. He called them his turtles, inspired by a trip to a turtle farm in Singapore, where he decided he could grow traders just as they grew turtles. The experiment was a phenomenal success. Over the next 4 years, the turtles reportedly earned an aggregate profit of over $175 million. Dennis had proven his point. Trading could be taught. But what exactly did he teach them? While the entry rules for their trend-following system were important, the absolute core of the curriculum was a revolutionary approach to position sizing and risk management. Each turtle was taught to manage risk based on the concept of N, which was essentially the 20-day average true range, ATR, of a market. A TR is a measure of a market's recent volatility. A high ATR means the market has been making large daily price swings. A low ATR means it has been quiet. The turtles' system dictated that their stop-loss for any trade would be placed at a distance of 2N from their entry price. For example, if they bought a contract of crude oil and its N value was $1.50, their stop-loss would be placed $3, 2 times $1.50, below their entry price. This was revolutionary because it tied the risk of a trade directly to the specific volatility of the asset being traded. But the real genius was in the next step, position sizing. The turtles were instructed to calculate their position size such that a 2N move against them would result in a loss of no more than 1% or 2% of their total account equity. This meant that if they were trading a highly volatile market like sugar, their position size would be much smaller than if they were trading a less volatile market like U.S. Treasury bonds. The dollar risk on every single trade, regardless of the market, was normalized to be the same small percentage of their capital. This system accomplished several critical things. It removed all guesswork and emotion from both stop placement and position sizing. The rules were purely mathematical and mechanical. It ensured diversification of risk. A catastrophic move in one market would only result in a small predefined loss to the total portfolio. Most importantly, it gave the novice traders the confidence to execute the system flawlessly. They knew that no single trade could ever blow them up. They were free to focus on following the entry signals without fear, because the risk was already contained. The turtle experiment is perhaps the most powerful proof that a mediocre entry system with brilliant risk management will always outperform a brilliant entry system with poor risk management. It proved that in the long run, your survival and success are determined not by how you get into trades, but by how you manage your risk once you are in them. This principle extends far beyond the realm of fast-paced futures trading. Howard Marks, the co-founder of Oak Tree Capital Management and a revered voice in the world of distressed debt and value investing, has built his entire philosophy on the superiority of risk control over forecasting. In his widely read memos to investors, Marks has consistently argued that the greatest investors are not those who can predict the future, but those who best understand and manage the present risks. He posits that there are two primary types of investors: those who try to achieve superior returns by correctly forecasting macroeconomic trends or market direction, and those who do so by controlling risk. Marks firmly places himself and his firm in the latter camp. His reasoning is simple and compelling. Forecasting the future is incredibly difficult. The economy and the markets are complex, adaptive systems with countless variables. Being consistently right is nearly impossible. However, understanding the current state of the market, the prevailing sentiment, and the price of an asset relative to its intrinsic value is a far more manageable task. For Marks, superior investing is about buying assets for a price that offers a margin of safety, a concept originally championed by Benjamin Graham. This margin of safety is, in essence, a form of risk management. If you buy a company's bond for 60 cents on the dollar when you believe it's worth 90 cents, you have a 30-cent cushion against error, unforeseen events, or a simple misjudgment on your part. Marx emphasizes that the goal is not to avoid risk entirely. That would mean avoiding investment altogether. The goal is to be intelligent about the risks you take. This means understanding the difference between the probability of an outcome and the outcome itself. A low probability event can still happen. A high probability bet can still fail. Therefore, the most critical task is to structure your portfolio so that you can survive a wide range of outcomes, especially the ones you didn't predict. This is why he is famous for saying things like, "You can't predict, but you can prepare." During the global financial crisis of 2008, Oaktree was able to invest billions of dollars into distressed debt at rock-bottom prices. They were able to do this not because they predicted the exact timing and nature of the subprime mortgage collapse, but because they had spent the preceding years from 2005 to 2007 exercising extreme caution. They saw a market characterized by excessive risk-taking, lax lending standards, and compressed credit spreads. They recognized that the potential rewards were not sufficient to compensate for the enormous underlying risks, so they held back. They raised capital and patiently waited, preserving their dry powder. When the crisis hit and others were forced to sell in a panic, Oaktree had the capital and the mandate to buy. Their greatest returns were not born from a brilliant prediction, but from the disciplined refusal to take foolish risks during the preceding boom. Howard Marks's career is a powerful testament to the idea that in the long run, superior performance is driven by the avoidance of losers, not the picking of winners. The imperative of risk control often requires not just a preset plan, but also immense intellectual flexibility. The ability to recognize when a thesis is wrong and to change your mind instantly, regardless of your ego. No one embodies this principle better than the legendary duo of George Soros and his chief strategist, Stanley Druckenmiller. Their approach was not based on fixed percentage stop losses, but on a dynamic and sometimes ruthless re-evaluation of their core market theses. If the facts changed, or if the market's reaction proved their initial idea wrong, they would abandon the position without a moment's hesitation. The most famous example of them being right was the 1992 trade against the British pound. They believed the UK's participation in the European Exchange Rate Mechanism, ERM, was unsustainable, and that the pound was fundamentally overvalued. They famously broke the Bank of England by building a massive short position, risking billions to make billions. But their willingness to be wrong is an even more important lesson. In late 1999, during the height of the dot-com bubble, Druckenmiller, managing Soros's quantum fund, initially resisted the mania. As a value-oriented macro investor, he saw the insanity of the valuations. However, as tech stocks continued to soar to ever more irrational heights, the fund's performance began to lag. The pressure to participate was immense. Druckenmiller capitulated, jumping into technology stocks just before the peak. In his own words, he bought $6 billion worth of tech stocks on a Thursday and Friday in January 2000. The market peaked shortly thereafter and began its precipitous collapse. The fund suffered a massive loss in a matter of weeks. A lesser manager might have frozen, held on, or even averaged down, convinced of the long-term potential of the new economy. Druckenmiller did the opposite. He recognized his catastrophic error in judgment. He liquidated the positions, took the enormous loss, and completely reevaluated his stance. He didn't let his ego or his initial multi-billion-dollar commitment cloud his judgment. The market was telling him he was wrong, and he listened. This brutal, swift, and decisive action, while incredibly painful, preserved the bulk of the fund's capital and allowed it to survive. He later called this experience the most humbling of his career. The lesson is profound. Sometimes the most important form of risk management is the ability to admit a mistake and act on that admission immediately. Ego is the enemy of survival. The market does not care about your opinion or how much research you've done. Its verdict is the only one that matters, and a successful trader must have the humility to accept that verdict and move on. In the high-stakes 24/7 world of foreign exchange, this lesson is amplified. Bill Lipschutz, widely considered one of the greatest FX traders of all time, learned the lesson of risk management in the most painful way possible. While still in college in the late 1970s, he inherited around $12,000. He began trading and, through a combination of skill and a raging bull market, managed to turn that small stake into an astonishing $250,000. He was a prodigy, and then, in a single trade, he lost it all. The entire fortune, built over several years of hard work, was wiped out because of one poorly managed position where he allowed a loss to run out of control. This experience, he later said, was the most valuable lesson of his life. It taught him that you can be right in your market analysis and still lose everything if your risk management is flawed. When he later went on to run the FX desk at Salomon Brothers, he built his entire trading operation around this principle. He understood that in the highly leveraged world of currencies, small price moves could have a massive impact on your P&L. Survival was everything. Lipschutz viewed trading as a process of accumulating small gains while rigorously cutting any position that wasn't working. He believed that the win-loss ratio for even the best traders was often not much better than 50-50. The key to profitability, therefore, was not in being right more often, but in ensuring that your average winning trade was significantly larger than your average losing trade. This can only be achieved by cutting losses without mercy. He often said that when you are in a losing trade, your mindset shifts. You are no longer objective. You start to hope. You might even start to pray. His rule was to get out of the trade before you reached that emotional state. The moment a trade invalidated its original premise, it was gone. This discipline allowed him to stay in the game long enough for the truly great opportunities to emerge, the trades where the risk-reward was heavily skewed in his favor. He proved that in the world's largest and most liquid market, longevity and profitability are not about brilliance, but about the relentless day-in, day-out discipline of controlling your downside. This theme of discipline and statistical advantage is central to the philosophy of Linda Bradford Raschke, one of the most respected short-term traders of the modern era. Beginning her career in the early 1980s as a market maker on the Pacific Coast Stock Exchange, she learned to think in terms of probabilities and edge over a large series of events. For Raschke, trading is not about hitting home runs. It's about hitting singles, consistently and methodically, day after day. Her approach is based on identifying recurring, high-probability patterns or setups and trading them repeatedly. Crucially, every one of these setups has a predefined tight stop loss. Her philosophy centers on the idea of follow-through. When she enters a trade based on a specific pattern, she expects the market to react in a certain way almost immediately. If the expected follow-through does not materialize, she considers the trade a failure and exits, often at a very small loss or even break even. She is not willing to sit in a position that is not performing as expected. This approach is the epitome of risk-first thinking. It keeps losses incredibly small. By cutting non-performing trades quickly, she frees up both financial and mental capital to be deployed on the next setup. She understands that any single trade is statistically insignificant. Her success is built on the cumulative results of hundreds or thousands of trades over time. This can only work if the losing side of the ledger is aggressively managed. A few large losses would completely negate the edge gained from dozens of small wins. Raschke's methodology is a powerful lesson for all traders, especially those operating on shorter timeframes. It refutes the idea that you need to have a strong conviction or belief in a trade. Her conviction is not in any single outcome, but in the statistical edge of her method over the long run. Her ego is completely detached from the trade. Being wrong is simply a data point, a small cost of doing business in the pursuit of a larger statistical advantage. This mindset, viewing losses not as failures but as expected and managed business expenses, is a hallmark of a true professional. When we step back and survey the collected wisdom of these market legends, from Livermore to Raschke, from Buffett to Dennis, a stunningly clear and consistent picture emerges. Despite their vastly different timeframes, markets, and methodologies, they all adhered to the same core set of universal risk management principles. Their greatness was not a function of a shared entry strategy, but of a shared philosophy of defense. First, they cut their losses quickly and without emotion. For O'Neill, it was a mechanical 8% rule. For Paul Tudor Jones, it was the moment a trade went against him. For Linda Raschke, it was the instant a setup failed to follow through. The mechanism varied, but the principle was identical. A losing position is a signal that your initial thesis is wrong, and the only logical response is to exit and preserve capital. Second, they never, under any circumstances, average down into a losing position. Jesse Livermore learned this lesson at the cost of his fortune, and Paul Tudor Jones built his firm around the mantra, losers average losers. They understood that adding to a loser is an act of ego, a refusal to accept the market's verdict. It compounds an error and transforms a manageable loss into a potentially catastrophic one. Third, they always risked a small, predefined percentage of their total capital on any single idea. For the turtles, this was a scientifically calculated 1 to 2% based on volatility. For Jones, it was about finding asymmetric bets where the potential reward was at least 5 times the small initial risk. This ensures that no single trade, no matter how disastrous, can ever knock them out of the game. It is the mathematical foundation of longevity. Fourth, their position sizing was intelligent and often tied to volatility. The turtle experiment is the purest example of this. They recognize that risking the same number of dollars on a volatile asset and a stable one is foolish. By adjusting their position size based on the asset's volatility, they normalized their risk across all trades, making their risk exposure consistent and controlled. Fifth, they always maintained a reserve of capital, dry powder. Howard Marks demonstrated how keeping cash ready during times of market euphoria allows you to be the buyer when everyone else is panicking. Livermore knew that capital preservation was essential to be able to act decisively at his pivotal points. Opportunity is worthless if you don't have the capital to seize it. Sixth, they always had a plan before entering the trade. The conditions for both entry and, crucially, for exit were defined in advance. For O'Neill, the exit was 8% down. For the turtles, it was 2N. For Soros and Druckenmiller, it was the invalidation of their macro thesis. The decision to exit was not made in the heat of the moment when fear or greed could corrupt judgment. It was part of the initial strategy. Finally, they all operated with a probabilistic mindset. They accepted that being wrong is a natural and frequent part of the business. Ed Seykota and Bill Lipschutz knew that a 50% win rate could be incredibly profitable if the wins were larger than the losses. They detached their ego from the outcome of any single trade. Being wrong was acceptable. Staying wrong was not. A small loss was a business expense. A large loss was an unforgivable error in discipline. These are not 7 different ideas. They are 7 facets of the same diamond, the universal, immutable law of capital preservation. This is the common denominator that links every great trader and investor across the generations. So, how do we, as modern traders and investors, apply these timeless lessons in today's markets? The principles remain the same, but our tools for implementing them are more powerful than ever. The key is to transform these philosophies into a concrete, systematic process that governs your own trading. First, you must define your maximum acceptable risk per trade. This is the single most important number in your entire trading plan. For most professionals, this figure is somewhere between 0.5% and 1.5% of their total trading capital. Let's be clear. If you have a $20,000 account, a 1% risk means you cannot lose more than $200 on any single trade. This may seem small, but it is the key to survival. With a 1% risk rule, you would have to endure 100 consecutive losing trades to wipe out your account. A statistical impossibility if you have any sort of edge at all. This rule dictates your position size. Second, calculate your stop loss based on the asset's behavior, not an arbitrary number or how much you are willing to lose. Use tools like the average true range, ATR, as the turtles did, to set a stop loss that respects the asset's natural volatility. Or use a structural stop, placing it just beyond a key technical level, like a previous swing low or high. This ensures your stop is in a logical place, not just a random point on the chart. Your position size is then calculated based on this stop loss. The formula is simple. Total capital times risk percentage divided by distance to stop loss in dollars equals position size. This mechanical calculation removes all emotion from the decision. Third, create and religiously use a pre-trade checklist. Before you ever click the mouse, you must be able to fill out this list. It should include the setup or reason for the trade, the exact entry trigger, the price of your stop loss, the price of your profit target, your calculated position size, and your current total portfolio exposure or heat. If you cannot clearly define every one of these variables before the trade, you are not allowed to take it. This formalizes the process and prevents impulsive, unplanned decisions. Fourth, implement absolute prohibitions. Your trading rules must have a list of things you will never do. At the top of this list should be, number 1, never add to a losing position. Number 2, never move your initial stop loss further away from your entry price. It can only be moved in the direction of the trade to reduce risk. These are the cardinal sins that lead to ruin, and they must be treated as unbreakable laws. Finally, implement a kill switch for your own performance. This is a circuit breaker for your emotions. For example, if you incur a loss of 3 times your standard risk unit, 3R, in a single day, or perhaps 5R in a week, you shut down all trading immediately. You are done for the day or the week. The purpose is not just to stop the financial bleeding, but to stop you from revenge trading or making emotional decisions while you are in a negative state of mind. You must step away, review your trades, and come back to the market only when you are calm, objective, and mentally prepared. These practical steps are the modern application of the wisdom of the legends. They are not suggestions for better trading. They are the minimum requirements for professional survival. The ultimate determinant of your equity curve over time will not be the magnitude of your winning trades. It will be the discipline with which you manage your losing trades. Anyone can get lucky and catch a big winner, but luck is not a strategy. The market will eventually test you, and when it does, it will not be your brilliance that saves you, but your discipline. The foundation of a long and successful career in the markets is built not on the spectacular home runs, but on the thousands of small, disciplined decisions to cut a loss, to preserve capital, and to live to trade another day. Your greatest opportunities will come, but they will be meaningless if you haven't protected your capital in the meantime. The universal rule is simple. Manage your risk, or the market will manage it for you, and its methods are always far more brutal.